Welcome out to Trading Justice 599. Joined with my brother Matt. These are the Justice Brothers from Tackle Trading, Matt and Mark. Going to talk about a little, you know how you give your kids when they do something wrong a timeout. At least some parents do that. Well, those individuals talking about recession, they're going to need a little timeout after this week's data. We're going to break that down. We're also going to look ahead at earnings. I joke and I'm serious all the time when I say my brother is a earnings expert. He is such an expert. I don't do any earnings work because I just rely on him because I've trusted his eye over the years. Obviously going to talk about commodities, the moves, a lot to talk about. Matt, how are you doing this morning?
Doing good. Excited to be here and to have a conversation on earnings here today. But before we do, obviously, break down the marketplace and go through the Skyline, and kind of the agenda here today in the podcast is take a journey through the Skyline as we always do. We'd like to look at the indexes, talk a little bit about the sectors, obviously look at kind of the news of the week, the stocks of the week, the economic reports of the week, the commodities. We call it the market Skyline, but we journey through it all, right? Then we're going to talk a little bit about stocks in the news and finish up the pod here this week on a short conversation on getting ready for third quarter earnings as they do kick off this week. And I don't call myself an expert.
I will believe it is a short conversation on earnings when I see it.
Listen, we're going to have a lot of detailed conversations on earnings over the next 4 or 5 weeks, and so we'll keep it macro here as we prepare for the third quarter.
All right, let's get to Forex Factory. Let's talk about the economy. There was a lot that went on in the market this week. The clear narrative, if you had to say one thing, for me, it would have been the economic narrative that came out of this week of a resilient economy. You could use the word strong economy. I think resilient is a better choice of words. Matt, we had economic data every day this week, not only exceed expectations, because you have the beat, you have the miss, and sometimes they're little. You had sizable beats, oftentimes in the line of highest number in a year, highest number in 9 months, highest number in 14 months, highest number since March of 2023. With the JOLTS report on Tuesday, ADP on Wednesday, ISM services on Thursday, and then, of course, with the monthly unemployment report on Friday, it was consistent. The beats were large, and it left us with a narrative that put those growth worries that were dominant in the market just 2 months ago on the shelf for now, right? They get a little timeout. What was your take from the economic data this week?
Yeah, it was a very important week, and in my estimation, it was one of the more important economic weeks that we're going to have over the course of the last month, and really kind of going into the next month until we talk about next month's labor market data. Quite frankly, labor market data is the most important data as we navigate the rate cutting cycle. And so certain economic reports are going to be important in certain economic conditions. When the Fed is in an interest rate hiking cycle, inflationary reports are going to be chiefly important. If the Fed is in some degree of pausing cycle, they both become fairly important. If the Fed is going through a rate cutting cycle, the balance of risk shifts to the labor side and the economic side of the equation. And so the economic reports that in the last couple of years that have not had a lot of love, quite frankly, by the market, they start becoming a little bit more important, such as the PMI numbers, both services and manufacturing. Chiefly important is obviously the labor side of the equation. And so the market is extremely sensitive to economic data right now. And they're trying to get an understanding of the soft economic landing equation. And when you're looking at the economic data this week, this was the first sensitive economic data week since the Fed embraced the cutting cycle from a few weeks ago. And for the most part, Mark, it was not only beats across the board, like you suggested, it was massive beats.
Yeah, it was non-debatable things, right?
No, you really couldn't. You really couldn't debate it. And when you're looking at the JOLTS report, for example, coming in at 8 million versus the 7.6 million expectation, that was a sizable bump up against the expectation and one of the better beats in the last little bit, like you suggested. Initial claims has not been a conversation for the last 4 to 5 weeks. It is as it comes in at 230, 225, 222, just kind of right in there over the last 3 to 4 or 5 weeks. So it really hasn't been part of the conversation. ADP non-farm came in as a big beat. And then when you looked at the labor market itself on Friday, average hourly earnings coming in at 0.4%, non-farm employment coming in well above expectation, 254 versus the 147 expectation. And surprisingly, the rate dropped to 4.1% from 4.2%. We'll see if the somral economic analysis will take that one back. But it was a really good week economically, to the point where, generally speaking, I think most people in the market are looking at an economic soft landing. And obviously there could be some conversations down the road in 2025 on the economic side of the equation. But as of right now, it looks like everything's getting pushed out to just that 2025. And whether the election's playing a role in it or not, that's kind of where the economic conversation is going. It's starting to get pushed further and further and further into 2025. And that's because of the positive economic data that you are seeing come across the board in the last week.
Yeah, no, this is a really strong bullish narrative. Now, when I was first analyzing markets as a trader, I tried to
bullish economic narrative. Right?
Yes, bullish
Markets
economic
are always a little different than the economy, but from an economic standpoint, it's hard to see recession in a week where you have GDP over the last couple of weeks at 3%, average hourly earnings going up at 4%, CPI at 2.5%. That's not exactly the macro environment where bears are going to party on recession analysis.
No, absolutely not. And they tend to be bullish for stocks. Now, there are other variables in how this can play out, and there are other things, and we'll talk about them throughout the podcast.
The number one environment, just sorry to cut you off there.
Yeah.
I was just going to join. The good news is bad news. Bad news is good.
Yeah, news. No, yeah. This is not one I'm going to overcomplicate. Now, down the road, if inflation picks up and you have several months of readings,
start having a real conversation on whether or not the central bank is going to cut as aggressively as they outlet. Yeah, at some point.
Yeah, but don't at least I am not going to overcomplicate this. I am in the, hey, listen, good news is good news. And the market is going to have to prove to me good news is not good news.
When in the last 3 weeks, we've had that conversation by certain pockets out of the market about the recession, and you get a week in the market where every single data point leads to the conclusion of opposite of a recession, it's a really good step in the right direction.
Yeah, I mean, I heard a few bears out there. Well, that means that the Fed won't cut as much. Yeah, I'm like, listen, you're
That's
5 months away.
Like cutting as much is not recession analysis.
The market likes, market likes simple themes. Bulls do very well in simple themes. Good economy, don't overcomplicate this. I have this still as a good news environment, unless inflation becomes an issue. And
we didn't see that on Friday, Mark. On the labor market itself, when you did see the labor market come out on Friday, you didn't see this massive volatility to the downside, which would indicate you're having an interest rate conversation more than you are an economic conversation. But on Friday, after the labor market came out, it was up, 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 up. And let's not act like the market was only dealing on the economic side last week, right? When you look at the market last week, it was chalk last week. A little bit of down, a little bit of up to end the week, but it was really kind of a chalk week last week. You're talking about the exact same breakout levels as you were the week before. You haven't really seen a changing characteristics against the marketplace, but it's not the only thing that the market is dealing with right now. Is just the economic piece. If Mark, if we were only dealing with the economic conversation in the market, we would
have hit all-time highs this week, right?
And then some. I think we would have picked up a little bit of momentum from Wednesday through Friday. But obviously the market's having other concerns right now. You have geopolitical concerns right now. The Israeli-Iranian situation has obviously sparked a significant concern in our world, in the market, obviously, and rightly so. You also had the dock strike that was a little bit of overhead throughout the week that got alleviated as we concluded this week as well. And then you have
there were certainly weights on the market this week.
There were macro concerns. And then let's both throw in the wrench in there into that. There's an election happening in 30 days. That's going to have a fairly sizable impact on the market as well.
Yeah, but you got to put the economy in the Bulls camp, and
I think
obviously,
so. Absolutely.
Israel is a wild card. We'll talk about that here in a few minutes when we get into commodities, dollar, and that. But technically, heading into this week, Matt, you have, one of the things that I appreciate about these markets right now is clear signals, right? I know if this breaks out, I'm not going to overcomplicate things. I understand there are geopolitical things that may not get me to be as aggressive. But if I break out of the SPY, I'm going to add bullish exposure. I'm not going to overcomplicate that. If I confirm on other things that I'm looking at, I'm going to play it. Maybe not as aggressive with the geopolitical concerns in the backdrop, but the one thing I do appreciate about the technical backdrop right now is I have levels in which tell me, okay, make a play.
Well, if you think the earnings environment is a little bit complicated, or the geopolitical environment is a little bit complicated, or the fundamental conditions is a little bit complicated, or the election cycle is a little bit complicated, I would agree with all of those things. I don't find the technical conversation to be complicated.
Very straightforward.
And that's the best way to navigate these markets when there is debates that the market is having, and rightly so. That's you're going to have a philosophy that's going to be priced into the market, that the market's opinion, that the market knows more collectively than you know regarding those situations. And so I see this as a technical conversation as much as anything. And when you are looking at the technical side, you got some pretty clean situations. The market's been consolidating ever since the recent breakout. It's threatening another breakout situation. On Friday, following a positive labor market print, you had a hammer candle going into a very well-known resistance level right around the 574, 575 level. The S&P looks like it is ready to break out. One thing, and I talked about this last week in the newsletter, I talked about it this week in the newsletter. When you were looking at the market last week, the one flaw technically the market had last week is you were technically overextended coming into a breakout. And oftentimes when you are technically overextended coming into a breakout, and in this conversation, I'm using RSI. RSI going into that breakout last week, at the end of last week, was all the way up around 85, 86. RSI oscillates between 0 and 100. That is a very high print for RSI. And it's a tall ask for the market, for you to ask the market to run on top of an overextended scenario. And so oftentimes what will happen, I talked about this in the newsletter last week, in the market playing a little bit more consolidation, is that you were overextended, and as you consolidate a little bit more, the RSI naturally comes down because the candles in the consolidation are not as strong as the candles in the early calculation of RSI, which would have calculated as before last week, these big upward movements in price coming from the support bounce that we had at 540. This week, that's not the case. This week, because of the consolidation last week, RSI actually came down underneath 70. Now it has this positive hook right around that 60 barrier, which basically says going into the breakout, if we do see that breakout, it's not a guarantee. It's an if A, then B. But if A, you do get the breakout this week, then B, you're not overextended going into that, which means C, you typically can see a little bit more momentum in those environments than when you are overextended going into a breakout. And so I do think the one thing we saw last week technically that did change in the market a little bit was through the consolidation, was it did alleviate the overextended conversation technically, as we are now going into that breakout this week. When you look at the indexes as a whole, I don't think you see them very differently.
Yeah, this is one of the things I had on my, talk to Matt on the podcast list, because one of the things we do as traders is like, all right, macro, because you and I, we are proud top-down analysts, right? Like, the market's giving a signal, we're gonna,
you get the index right, you'll get a lot of other things right.
You get a lot of other, it just makes life easier. But then we will go in that top-down approach to, all right, is it tech, is it this, is it that? Other than not wanting defensives outside of utility, is that we see a lot of, like similarities in some of the major things still, don't we?
Well, one of the better calls we've had in the last month or so was the defensive rotation into cyclical and aggressive being the base case coming out of the central bank, officially going into the cutting cycle. And in general, that's what we have seen. It's, to me, it's not really an index conversation as of right now. RSP is not that dissimilar, for example, to the SPY. When you're looking at the Dow Jones isn't that dissimilar to what we're seeing over the last couple of weeks of consolidation in the SPY. And so from the Dow Jones high base potential breakout, which looks really clean, to the SPY consolidation breakout, to the RSP consolidation breakout, they're all breakout scenarios hitting into an all-time high resistance level. The path might be slightly different, but they're all running on a little bit of the same gasoline. The two indexes that are looking a little bit different from an overall pattern perspective is the NASDAQ, which came from a bullish retracement with confirmation on Friday. That looks really, really good going into this week. And then on the small and the mid cap index, you had a little bit of a different pattern, more similar to the Qs, where you had a choppy bullish retracement. I wouldn't call it confirmation because of the choppiness on Friday. I still think it's got some work to do, and the real trade is not until you start breaking out of 225 on IWM. And so, yeah, I don't necessarily think this is a index conversation. It's been a sector conversation. And in general, what we have seen, and our rankings do suggest this at Tackle Trading in the newsletter, and you definitely want to check out the newsletter every single week, not only for the technical updates that we do in the newsletter. Obviously, I break down all the different indexes in quite a bit of detail. I go through earnings every single week, but we also do the rankings every single week on the sectors as well. And in general, Mark, couple weeks ago, these sectors were all kind of aligned with one another as we were having that macro conversation on the central bank, and defensives were really, really, really good. But going into the central bank a couple weeks ago, both you and I made the statement that it was our base case, because of where defensives were in a late stage trending environment, that we were going to see a little bit of rotation, and we have. Consumer staples is now in some degree of neutrality. Healthcare in some degree of neutrality. Real estate, deeper retracement. Utilities is the one sector in defensive that has stood out amongst the pack, because they're running on the AI build out, infrastructure build out right now, and so they have certainly separated and are trading more like an aggressive sector. But in general, I would say outside of energy and cyclical and utilities and defensive, the rotation has been, and both of those two areas have specific stories that are impacting those spaces. Utilities with the AI build out, energy obviously with the Israeli Hamas and Hezbollah and every other proxy from Iran in the Middle East right now. So they're a little bit of a unique conversation from a sector perspective, but that is the base rotation. Now, if we see further rotation here, it's going to be based on earnings coming up and not based on anything we've been talking about in the past, in my estimation.
Yeah, we'll get to talk about some of those earnings here in a second. So pretty, listen, there's been a lot of positive news, and I want to get into this coming week in Forex Factory, the economic events that are coming up. But when you look back at the last couple of weeks, I look at a lot of positive news for bulls, kind of led into our cautiously optimistic last week, right? Liquidity is flowing. You have Chinese stimulus. You have a U.S. rate cutting cycle. You've had, a lot of positive semiconductor news. One of the stocks in the news, I'll talk about that here more in a second. You've had positive news out of semiconductors, and semiconductors remains a very important space in the market, right? Might not dominate the headlines like it did at the start of the year. Really, important space. It's a good setup for the bulls right now as we head into this week. And Matt, inflationary data coming up on Thursday. This is a really, really, really light week on economic data. It was a busy week last week. This week, we're gonna come into earnings. Not only is it light this week, it's light the week after as well. It's inflationary data, right? We had hot reading in the wage number on Friday, we had hot readings on the CPI and PPI a month ago. Not enough to cause people to panic, but they're one of those, hey, we make note. If you do not have hot readings, Matt, well, good news is certainly good news. And it's
Define
really
hot though this week, because I And I'm serious. Like, I know a lot of times we wait to get the print, but like when you're looking at these inflationary numbers and asking the question of how sensitive the market's going to be to the inflationary data, you got to talk about expectations coming into that, because if you're talking about hot year over year data, you got to go above last month's hot year over year, which was 2.5%. Based on the expectation, we're supposed to come into 2.3% on the
Yeah, okay, so 2.4 would be technically hot, but I wouldn't consider
but
that hot.
2.4 wouldn't concern the market. That's my
Yeah, yeah.
is 2.4 isn't concerning to the market long term. 2.5 above 2.5, yeah, but the way it's set, you got to have a sizable miss.
Yeah, you have to have a sizable miss
this week. And I'm not trying to say that it can't occur. Obviously, economic data and the expectations are a snapshot of what is expected. Obviously, we could see sizable misses or beats on any economic report. But when you look at it from a probability perspective, and the expectation is set to 0.2 points lower year over year than what it came in last month, Mark, this market's not going to have a double dip inflationary conversation at 2.5%.
It's not.
It's just not. And the expectation is supposed to come in at 2.3%. And so I just don't feel like the inflationary data from the PPI report on Friday, expectation of 0.1% to the 0.1% on Thursday with the CPI data year over year expected to come in at 2.3. You're going to have to see a sizable a sizable miss on inflation for the market to get too ramped up.
I think the inflationary data this week is set up for bulls to be a heads, bulls win, tails, bears lose scenario, right? Either it comes in at expectations or below, bulls win, or maybe you have a slight uptick, but nothing concerning, bears, you still lose in that.
Well, and let me ask you a question on the things that are happening in our world today. Isn't it the energy? Isn't it what is happening with energy where you would get a little bit of concern down the road with inflation?
Yeah, no, this is not saying, because if you're listening to us,
that's not in the CPI
time,
report this month.
That's not in this month. Matt and I break down things from tactically what's happening right now, how to navigate, and then we have things that we look ahead. We do not think inflation is going to be never talked about again.
No, I think it will be discussed next year.
Yeah, I think it is. It is an issue that it's going to.
The market's going to face things happening right now, specifically that the market is not too concerned on the inflationary side. Yes,
if I win a few bullish trades in the coming weeks,
how many times do I have to say the Fed has made a mistake embracing a cutting cycle too soon? That the economic data did not justify the Fed embracing a cutting cycle, and I would have waited till post-election to embrace that. That is my personal opinion. I have stated it here many, many, many times. I do believe inflation will be a concern throughout our entire lives. That's why we promote gold a lot, quite frankly, is because of those concerns. But long-term concerns versus short-term strategic critical thinking is a vastly different thing in the market, in my estimation. So no, I just don't feel like the environment is set up based on the expectations on the inflationary side just this week for the market to get too concerned about inflation this week. That doesn't mean the market is going to break out and run. There's other concerns in the market, i.e. the geopolitical ones. But from an economic to inflationary side, I just find it hard when you're talking about the macro numbers. Okay, the macro numbers are as follows: GDP is currently at 3%, just in terms of the Atlanta now. Wage growth is at 4%, and the CPI is expected to come in at 2.3% this week on a year-over-year number. Those numbers are not numbers the market historically concerns themselves with when it comes to the macroeconomic environment. That's my general point on how the inflationary side is looked at. And then secondarily, inflation does become a secondary factor in importance to the market during rate cutting cycles. It's really sensitive to economic data. Typically, it discounts the inflationary data a little bit until it becomes right in our face that we have to deal with it. But 2.5, 2.3% against the inflationary conversation over the course of the last 2 years, the market is not going to concern themselves with that number, in my estimation.
Yeah, no, and pretty good case for the bulls, pretty good narrative things, but there is a huge, massive wild card in this whole mix. And let's talk about those geopolitical as we look at gold, oil. You pick your chart at the start. As of the time we are doing this podcast right now, there hasn't been a response directly on Iran after Iran launched, what was it, about 200 ballistic
It's
missiles?
190
Yeah,
ballistic missiles, about twice as much as they did in April.
yeah. So didn't cause any substantial damage, but Israel has vowed to respond. Iran has vowed to respond if Israel responds. We don't know.
Iran didn't respond the last time in April that Israel responded. Iran basically said, we're going to take our ball and go home off of that one.
And that would be from a market perspective an ideal situation on whatever unfolds, but we don't know the nature.
My base case on that.
Yeah,
I think
that's why we.
I think Israel punches back. I think they stop short of nuclear or oil, and I don't think Iran does anything. And I think
Iran that would be a best case for the market. Markets
for Israel to not hit them again. Like that's my read on
if that is how it plays out. And earnings season.
I read on Iran is
this market could hit 6K on the SPY by election. Right, there's enough tailwinds, and that's not like it's that far, right?
Well, and it's also not a guarantee Iran responds, not Iran, but Israel responds in the short term. Like Israel's going to play this the way they want to play this, and they have every right to play it that way.
And so, but there are, we'll see how it plays out. If it does not play out that way, if they do hit oil fields, that's a good calculated guess on your part. I'm taking it from a technical perspective, realizing that there might be some wild cards. Yeah. Just in case. Let's just say I'm not selling a million naked puts. I'd be more like, tactically trying to navigate and make a few bucks in
what is I find the Iranian-Israeli conversation fascinating from a political perspective. I could sit down and have a conversation with you for another 45 minutes just on that. Obviously, that's not what we do here in this podcast. My question to you is this. What would you need to see on crude oil itself and energy secondarily for you to start building confidence on executing your trading systems and your trading philosophies? Because you do a lot of cash flow in energy and oil.
I do. Yeah, no, and if you come back down, regardless of the geopolitical situation, I'll add exposure. That's what I've been.
Come back down. You're talking a radical.
Yeah, like 69, 68, where I can start selling naked puts again, right? A nice, bigger move down. That's how I navigate commodities. And so, geopolitical or not, commodities, when I get large sell-offs, I tend to start adding credit. I haven't had a pattern to work with in like 4 months. Right. And so
nobody has there has not been a pattern of crude oil in a long time, ever since Saudi Arabia, after the deal, they didn't extend the deal on the oil cuts, which had been in the market for a couple of years. From I want to say April of 2020 through.
It has been a technically difficult environment.
Been all over the board. And so for you just need something to the downside. For me, I need a change of behavior from a technical perspective.
We all do. For me, I might fool around with a few naked puts, yeah. But to do anything,
I need Doji Fest.
Yeah, and a Doji Fest not at the top of the chart, because if you do a big rally and you Doji Fest, I'll assume that's setting up for a move down.
I will assume a high base here. Doji Fest would not be the best, but I'll just say like this. As of right now, I have zero confidence on where crude oil is going to be on Monday.
Yeah, I don't have any idea.
Right. It's and the thing about it is when you have all the market indexes in breakout scenarios or retracement scenarios, there's the bull list this week on the traders report for our pro members was expansive on the bull list, pretty contracted on the bear side. I don't feel the reason why people would force them into the crude oil or energy conversation when there's so many other more compelling, maybe not compelling, maybe that's not the right word, but more cleaner, easier areas of the market, I would say. In fact, I would say energy right now is probably the most difficult area of the market, and I don't think it's a close second.
Yeah, no, it is. A degree of difficulty is high. Eventually we'll have that change into characteristic. Eventually, we'll have a change of characteristic of gold as well, but I'll believe that when I see it as well. Another week, strong economic data, dollar rising, yields going up, and gold has a tough time going up in those environments. But you go back over the years, you see, you wouldn't know.
I,
We've seen this all year long. Things where gold should sell off from a textbook perspective, where it just says, "Nah, I don't want anything to do
I
with
tell you
that."
right now, this entire year, I have been far more impressed with the consolidation and the lack of volatility than the upward movements in
Yeah,
price.
I've said that many times in the newsletter. Like,
Like,
that's
just beyond impressed that gold is held up. And this week specifically, I'm not surprised that the dollar had the week that it did. I'm not surprised at all. Like, this was kind of built into the pie for me, anywhere between 100 and 102. I didn't really have any concern on the commodity, on the precious metal or the industrial metal side. I felt like that was built into the conversation. What was not built in was the how aggressive it got this week. How every degree of economic data was a beat. The dollar had to reflect that. Then you had the geopolitical bid that was happening with the dollar. Dollar is a safe haven currency, and when you do have geopolitical concern, as we had the last couple of weeks, due primarily to the Middle East, the dollar, especially in the last week, it just safety bid, economic bid, you name it, it was going up, 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 up. In that environment where you have this type of strong parabolic move on the dollar, to have gold not sell off, not close underneath the 9 EMA, I don't know what to say other than I am so impressed. And gold is obviously forming a little bit of consolidation at the top. You're looking at a secondary trigger above 2,700. I said about a year ago, this is a journey to 3K. No, this is a journey to 4K over time. Like, this thing does not have a top end risk graph that I would not agree with. So I'm very impressed with gold. It's the number one confidence we have in the marketplace. And it's another day that ends in Y. So if you don't have a gold position you're managing in your portfolio, this is a good day to start building one. With that said, I kind of like silver on the directional side a little bit more. Silver tested a breakout channel against a multiple time frame on Friday, tested above that level, could not close above that level. I think that was a gift for a lot of people that maybe were not tracking this on Friday, because
yeah. I mean, I added on Friday. I added
so did
silver on
I.
that.
Well, I've been adding along the way, but
Yeah.
I fully anticipate a breakout here. Now, I'll be the first to say, you saw it on Friday, breaking out of a multiple time frame resistance level when the dollar is doing what it's doing is a tall ask. It is a very tall ask, which means we might not see that until we see a little bit of a pivot, slowing momentum on the dollar first. And so a little bit of a combination situation here is, if you do see slowing momentum in this parabolic move we've seen in the dollar recently, and that pivots back down, I think that is a 1-2 situation for the commodity side, both gold, silver, and copper, that are very interesting. And when I am looking at those, I would rank them as quite frankly, one, and I'm talking new stuff, not old stuff. Old stuff, it's gold, gold, gold. But new stuff, I would actually look at silver in new trades. I'd look at silver in that 29.5 breakout more than I would be looking at gold in their consolidation high base type of breakout that they're looking. Both look good right now, but I do like the multiple time frame situation on silver right there around a close, and again, close above 29.5. But you do that, I just feel like silver can play catch up here, Mark. I just feel like silver can play some catch up. And when silver wants to play catch up, it can play aggressive on the catch up side of the equation. Silver is still 20 points underneath its all time high. 20 points underneath its all time high. When you come look at gold, gold broke its all time high many, many, many times this year and is well above that. In comparison, Mark, this is where silver is on the gold chart, all the way down here. And so I do believe in the catch-up story. It doesn't happen often, but when it does happen, it can be very, very parabolic and very aggressive. So it's an aggressive conversation, but silver versus gold, which one would you take?
Take silver. Listen, just because it's potential, right?
Yeah.
Plus my ROI on I got a covered call when the intraday thing. Covered calls are pretty good. Naked puts are pretty good, but I don't want to miss even as a cash flow trader the direction here.
Yeah.
So like it's just a good play. It's just a good play. Also interested in copper if it breaks out of its resistance level. Those Chinese tailwinds still have my interest. A little bit of a digestion week, which after that big a move, if you want to see. And I like how you say that, like, do your favors, right? Because I don't have any copper exposure right now. I would like some. Waiting for that breakout to occur here. It's pretty clean as well, isn't it?
It is, but it's more volatile. It's choppy at the top, and I don't have it nearly as clean as I do gold or silver. So I would rank it third in those, but it also has the best momentum and the clear catalyst out of China as well. That's why it's being a little bit more aggressive. So I'd like to see it simmer down and settle in. I don't love volatility at the top end of a trend. It is one of the number one things that drives me crazy. And so I would love to see that get dialed in a little bit.
And then let's go to Bitcoin briefly. Listen, I'm tired of Bitcoin trading with risk assets. I need Bitcoin to do something on its own. Wow, we had an update on Friday, Matt. Bitcoin went up. We had a down day on Tuesday in the markets. Bitcoin went down. I would like to see it because gold's doing its thing, right? It's not trading with it. Silver doing its thing. China and copper doing its thing. Bitcoin's just trading with risk assets right now, and it has me very uninterested in Bitcoin until that changes, until I see some relative strength out of Bitcoin.
Yeah, I'm right there with you. It's trading with the risk assets right now, but it typically does trade a little bit more with risk assets than it does with gold.
Yeah, well, there are times though Bitcoin will do it. I would like to see a stretch where the market goes down a couple of days, Bitcoin goes up. That will catch my attention until I see that.
Not gonna happen.
Plus, there has been, and it's worth noting, Bitcoin gets severely punished on geopolitical headlines. It gets that oversized move down. That characteristic has been there for a while now.
Such a weird thing. It's such a weird thing because every safe haven got a bid this week. Gold held up, dollar got a bid, currencies out that were safe havens got a bid. Like safe havens got a bid early, and Bitcoin didn't trade right there with risk assets.
Yeah, so I just no interest in Bitcoin until I see changes in characteristics of adding anything to manage my existing. Let's get to stocks in the news. Got a few stocks for you to discuss, Matt. Some in the news, some to be in the news here in a second. I'm going to cheat a little bit here. First of all, NVIDIA. NVIDIA came out, and Matt never knows the stocks I'm going to bring. So he never knows the stocks I'm going to bring. NVIDIA, the fabulous CEO talking about insane demand for his products. Talked about this week, reminiscent of a few weeks back when he talked about it again, pointing to that. We've had a lot of positive news. Micron, NVIDIA, semiconductors pointing to, demand being there as robust as ever. What do you make out of the chart right now? We know NVIDIA, we know the story.
About stinking time we got some positive news out of the semiconductor side of the equation. It's been a good 3-4 months of nothingness in this space. Little chop, little down, little up. Starting to see improving conditions in semiconductors in general, obviously, as the NASDAQ has formed up a little bit more. But even in the NASDAQ forming up a little bit more, semiconductors have not led that charge. It's kind of been a general space situation. Does the NVIDIA news, and by I mean news, Jensen coming out and saying we have insane demand for the Blackwell GPU, does that spark a little bit of momentum here? I'm certainly interested. We had AMD on the report, and I like NVIDIA here as well.
Yeah, next, let's get the negative out of the way. Nike. Just was interested in Nike. It was the biggest earnings number of the week. Didn't really tell me anything other than Nike. There was no like macro implications on this one or even sector implications. But Nike, reminder that sometimes it can take a minute for a stock to break out of its doldrums.
Well, it ain't going to do it this time. You remove guidance all the way in 2025. That's never going to be a good look for the market. The market trades in the future, and when you tell us you don't know how the future is going to play, it is a sell first, ask questions later environment, and that's exactly what Nike did. It doesn't matter that Nike beat their EPS by 20 cents. It doesn't matter that they beat their revenue. It doesn't matter the veracity of the beats. It doesn't matter anything on what they did in the quarter, because the market doesn't trade in the "what have you done for me lately" scenario. It trades in the "what will you do for me in the future." And Nike removed guidance, and we're not just talking the quarter guidance, all 2025 guidance. And so no, that's going to obviously be a sell first, ask questions later. And the technical environment very choppy on Nike.
Yeah, next one is Google, a little combo actually, Google and CCJ. Google CEO in
Weird
a
combo.
but not when you hear the news.
It's a weird combo historically.
Yes.
Yes.
But there was, in a busy macro week, you might have people out there listening might have missed this little news tidbit. But Google CEO came out and was talking about different things and talked about nuclear power and how Microsoft recently had purchased, large blocks, basically purchased 3 Mile
3
Island.
Mile Island.
They said, well, we'll just buy 3 Mile Island because that's how much power we'll need. And Google pointing to the fact that, we're kind of thinking along those same lines. Nice pattern on Google as we start the new week. I like that, but I like the this nuclear theme has gotten so much positive news. We saw uranium stocks just skyrocket. No new entries.
And one of the best trends we've ever seen in utilities.
And it's one of those things to remember as a trader. Just because there isn't a new entry on uranium today, don't ignore it 2 weeks from now or 3 weeks from now when there is.
We think these massive $3 trillion tech companies that trend of providing their own power is just going to automatically stop.
Yeah, that's a narrative that has,
unless the government stops it. And I haven't heard a word out of the government, and nor will we forever, because the government is usually years behind on this conversation. So yeah, this is an ongoing one. This is a long term. I got utilities and uranium as part of the secondary AI infrastructure build out plays, which I'm not surprised that we're having that conversation. I knew it was going to happen. I am surprised that we're having it this early in the AI build out. I am surprised by that. These AI companies are moving at a speed that is unlike anything in history, quite frankly. And I'm not surprised that Google's getting into the conversation. The problem with Google right now is it had a terrible quarter last quarter. It is forming a reversal here, but you're right in front of earnings, and you got the 20 weekly on top of the price action. If the 20 weekly was not on top of the price action, this would be a really good situation right now.
Next one is a little look ahead, a combo of Tesla and AMD. I bring these up together because they both have events on October 10th. Now, October 10th has been a date I've had circled on my calendar for a couple weeks now. One is CPI day, right? In a week where you don't have a lot of economic catalysts, CPI happens on October 10th on Thursday. You also have Tesla's robo-taxi day coming up this Thursday, and you have AMD AI day. That you have in a light week at the start of the week. That's a lot of big names and stuff on a Thursday this week, isn't it, Matt?
It is, and I don't want to discount any one of those data points that are coming in because they're all important. If I had to rank them, I personally would say AMD for me. The anything when you're talking about the number 2 semiconductor company in the world announcing anything that they're going to be doing in comparison to NVIDIA, that's going to be a really important conversation. So anybody that gets involved in tech, semiconductors, AI, AMD this week is going to be an important data point coming into the market. But I don't want to discount the robotaxi conversation out of Tesla. This is a growth. That's part of the growth conversation for Tesla, and so I don't want to discount that. That's a really important one. But I want to put it at the same level as the AI conversation is as of right now, given the fact that AI is having an immediate impact on not only these companies but our world today. Robotaxis is down the road a little bit.
Yeah, okay. So on that final one I have, which is a lead in, is JP Morgan. little bit of a cheat, but I thought it would make an easy transition into earnings conversation. You have the start of earnings this week. You're gonna have Pepsi on Tuesday. I think Delta is on Thursday or Wednesday. But then you have the official start of earnings season on Friday when the big banks. It gets into our earnings conversation here, Matt. What are your general thoughts right now? Like here we are heading into earnings season. What are your general thoughts as we approach this earnings season, which
Well,
has not got a lot of discussion in any of the media because there's been a lot of other things
there's
going
been a
on, right?
lot of other things to talk about, honestly. So it's understandable to have an earnings conversation get kicked to the rear view a little bit. In general, this will be the fifth consecutive quarter that we've seen EPS growth. This will be, I think, like the 17th consecutive quarter on the revenue side of the equation. But unlike last quarter, I think in general, I think the market is ready for an earnings conversation. And what I mean by that is last quarter, the market was kind of at the high point, for example. So when you go back to last quarter was the July period. July happens pretty much April through June. The second quarter was nothing but up, 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 up. And so the entire quarter was up, 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 which means you were very elevated in price going into that quarter. That's number one. Number two, earnings revisions, which are very normal for the market going into earnings season, were not revised down the same way that they have historically been revised down. And so the market was at an all-time high. It was overextended going into earnings season, both technically and fundamentally. You did not have revisions to the downside, which meant the first 2-3 weeks of earnings season last quarter, we were dealing with quite a bit of volatility, honestly. And obviously there were things that were happening in that time period, the same way there's things happening in this time period that are different then versus now. But when you're going into an earnings season and you have very high expectations, you have high expectations because of where the price is, you have high expectations because of where the fundamental values are, you have high expectations because the revisions were not lowered going into last quarter. And last quarter was also the first quarter that the blended growth had a chance to get above double-digit growth really since before the pandemic. And so the market was primed, but the expectations were sky high going into earnings season, last earnings season. And I do believe that played a role looking back historically at the volatility we saw in July, with the volatility we saw throughout August. I do believe that was the case. So expectations were really, really, really high going into last quarter. When you think about those expectations going into this quarter, and we kick off this Thursday, Friday with Delta, Pepsi, you get a couple healthcare, and then obviously you get the banks with the traditional JP Morgan start on Friday. The first week and a half of earnings season is all banks. 50% of the entire financial space reports earnings. It's a little bit of secondary healthcare. You get a little bit of the cyclical, but there's not a lot of reports in the first couple weeks. The first week and a half. That's from Friday till the week and a half from that point. The expectations going into this earnings season are not nearly as high. Technically, are we
And this was a big thing. If you listen to the podcast before last earnings season, and we didn't have great earnings reaction from just price action. And Matt laid this out ahead of time, and he's like, "Listen, expectations are too high. They're too high. They're too high, and they're too high." And it doesn't, and it didn't create the environment where you could generate the juice, right? To and here we are. We're not that far.
Listen, you don't generate a juice by the EPS print itself. You generate juice by the percentage of the beat against the EPS. And so, for example, when you have a company come out and they have a 5-cent beat, nobody cares about a 5-cent beat. That is built into the entire conversation. We typically see like an 8% beat against expectation. And so when you beat 5% mark, and we typically beat by 8%, I'm sorry, that's not a good beat. Yeah, did it make money? That's not the equation why stock goes up or down, just if they made money or not. There's other evaluations to it. And so, yeah, there was a very high bar expectation. Now, the question is, where is that bar today? That bar today has been significantly lowered. We've lowered the EPS expectation in the blended growth from right around 8% down to around 4.2%. And so the expectation has been lowered substantially, about as much as we see on average over the last 5 to 10 years. And so expectations on EPS have been significantly lowered on average with what we typically do see. So number one, the blended growth this time going in is not, because of the EPS revisions we've seen over the last month, the expectation is not nearly as high this time. The price, yes, is the price higher today than it was when we started earnings season last go around? Of course it is, but it's only, we're talking a few dollars here, Mark. We're not talking massive upward movement in price. From quarter to quarter last time, Mark, when you started embracing the first quarter reporting season, you went, and first quarter reporting season starts happening in mid-April. When you saw that, Mark, after that, it was nothing but
We saw a major leg.
Up, because you had low expectations here. You were coming from a low price and it was a beautiful trend, but then you were at the higher price. This time around, you were at 565 when you were going into last quarter's earnings. Yesterday, not yesterday, but the day before Friday, we dinged 565 on the low point. And so it's not exactly like we've seen this robust, yes, has the market recovered really, really well in the quarter, but we haven't seen that robust growth in the market. And so the expectations are set a little bit lower from a blended growth perspective, from an earnings perspective. I think they're also set a little bit lower because the technical environment is not nearly as overextended as we were going into last quarter as well. And you're also talking about next quarter, meaning the fourth quarter. Mark, EPS expectation on blended growth for next quarter, we won't know exactly where that is for another 3 months or so, but I'm willing to bet it's above 10% on the expectation, above 10% EPS growth year over year going into the fourth quarter. Right now we're at 4.2%. And so I do feel like we have an opportunity here that we may not have had last quarter, in the sense that, honestly, I thought the market had a good quarter just to fight back up to the recovery level that it gave up in the first part of earnings season last quarter. This time, you're starting out with a much better macro environment, in my estimation.
Yeah, no, it's not a bad setup, right? And I do find some, in April we had geopolitical conflicts that set the market. Earnings season helped set preceded earnings, set a stage for earnings after some market stability to start some momentum. And let's not forget, however it plays out in the short term, we are heading into a very seasonally favorable period of the year coming up.
Well, and you go look at it last year, Mark, right? When did the market bottom out last year? Now, obviously, different year, different conversation, but it did bottom out in the third week in October before it had a beautiful trend after that. You go back to it another year behind that. October was the bottom price of that, and that was the second week of October before it got back in. So, seasonality is pretty strong in right around second, third week of October. We're going into, the second week of October this week, but seasonality is pretty strong this time around. Somewhere around the second, third week historically is where we see some bottoming actions. Now, different environment. We just broke out of the S&P, so it is different, but it's positive seasonality nonetheless.
Yeah, no, and it's one of the things that has crossed my mind more than once is a little front running of earnings and front running of seasonality in the month of October. It's like everyone I'm going to wait till November. And I'm like, markets have a tendency to front run what you think you're going to wait for, right?
Anybody doing anything is already front running that. That's why the market's at an all-time high and not at a low point. So it's a little bit of a different conversation.
So there's a lot of tailwinds. Like, Matt, how could, let's play devil's advocate for a second. What would a bad earnings season look like? Okay, so you have low expectations, right? Lower expectations than last one. That's a positive from a game theory type of perspective. What would a bad earnings season look like this quarter?
A bad earnings season. Are you talking macro numbers?
Yeah, just or general or thoughts or
Blended growth of
narratives.
4.2%. If we don't achieve 7%, I'm gonna say you're capped out on some level, because
So
again,
7%.
and that's a minimum.
Yeah,
That's an absolute minimum on blended growth. If you starting the quarter at 4.2 and you only improve, what would that be? 2.8 up to 7 when you traditionally go up 7.8. Yeah, I would say that's a bad number, especially with expectations getting revised to the low side of the equation. You better get to that 7-8% number on the blended growth number. Percentage beat on EPS. You better beat 5 and 10-year averages on this one. And again, here's one thing, Mark. When the expectation gets set low, that's one thing, but you still got to beat those expectations, and you got to beat them healthy. So I would say EPS has to get above 78% on, about 75% on the beats. That would be, I think that's cooked into the pie, quite frankly. Revenue above 60%. And so I would say EPS beats on a bad quarter underneath 72%, revenue beats underneath 60%, and blended growth underneath 7%. If we don't get those minimum standards, the market will sell that environment.
In last earnings season, one of the things you had a couple semiconductor.
By the way, I track blended growth in the newsletter every single week.
Every week I follow it. It is one of those. I asked Matt. I asked him set stages early on. I asked him to update it every podcast. I follow it in the newsletter myself as a consumer. Certainly looking for those storylines, right? Because one of the things is like when you get the earnings results and Matt gives them, I'm like, oh, I can count earnings as a positive midst of all the other decisions in the coming months. It's very, very helpful. One of the many reasons check out the newsletter. Now, Matt, on a micro level in earnings, last earnings season, we saw a couple semiconductors early set kind of a negative tone, right? Like they had a couple, and markets really reacted negatively on those days.
They had price reactions. I'm not sure they had a negative tone. Know the companies you're talking about, and they actually beat. And so if you'll recall last quarter, it wasn't a negative tone that the earnings was doing. It was how should I put it? It was the lack of growth that they were seeing.
And markets came out selling, right?
Yeah, because I'm sure you're talking about Taiwan Semiconductor on one of them, correct?
Well, semis was great. And there was what was it, the ASML, and there was another one as well.
It was ASML and Taiwan Semiconductor. ASML lowered guidance for the first time. That sparked fear in semiconductors, which was having a growth upon growth storyline. ASML was the first company in the AI infrastructure build out to lower, that had a direct impact on AI to lower their guidance. And then you had Taiwan Semiconductor come in with a decent beat against EPS. I'm doing this off the top of my head, so I apologize if I'm not 100% accurate, but they had a guidance that was a little bit concerning. It wasn't a drop in guidance, though. In fact, I want to say Taiwan increased guidance, but simply because ASML had lowered guidance, it just put a dark cloud on the entire, it put a dark cloud on how every single earnings report out of the AI and specifically the semiconductors were viewed. They were viewed in the light, in the lens of ASML lowering guidance. And so it was a little bit of a difficult start for those semiconductors with ASML, Taiwan secondarily. But again, that's kind of why we haven't grown in semiconductors over the last 3 months, Mark. It's kind of why we haven't seen any significant trend here in semiconductors since that time period. Because since that time period, and you don't have to go too far here, it's this gap right here. That's the gap on the ASML earnings report. It gapped second week July, gapped down, really didn't recover since then. And so you're talking about going into this earnings season with the potential to start a new trend here.
Yeah, you really do. Absolutely.
And I think it's whether or not we see it or not is a different conversation. But in terms of anticipation, I personally am anticipating a little bit more bullish love coming out of this earnings season than we got last earnings season, which was, quite frankly, the first 2 weeks of last earnings season was a shit show.
When these hot areas of the market take several months off, you gotta pay attention on upward momentum signals. Like that's just like a trading truism. Trading truism. Any other thoughts, Matt? Like on this upcoming earnings season?
It's always, I love earnings season. I have a love-hate relationship with earnings season. I
You do love earnings season.
I do love it, but I also hate it too. I love it going in. I usually hate it by the fourth week. It usually is kind of how it works. But the reality is it's not a matter of, it certainly is important to have an understanding of the environment going into that, because you'll have context to understanding the price actions and the gaps that will occur as we see over the next 2 weeks or so in the early earnings season. Every earnings season is different. Everyone's full of variables and landmines that we have to navigate. There's no doubt about that. But at the end of the day, we're going to be covering this every single day. And when we see these major data points that come out in our earnings that spark momentum either to the top side or to the downside, we're going to be covering every single day in the Traders Lounge. We'll be covering the high level, updates every single week in the newsletter. And so this is going to be an ongoing conversation for us at Tackle Trading for the next month. But this is where trends get made, is earnings season. This is the birth point of trends, is earnings season. This is the birth point of themes in the market. And what we typically see in the first couple weeks of earnings season is little micro themes that develop from a macro perspective. And that usually happens on the finance, the cyclical side when you get into healthcare in the second week. Realize one thing about earnings season. Earnings season kicks off this Friday with JP Morgan kicking off. We've already had 20 S&P 500 companies report for the third quarter already, Mark. This JP Morgan starts the season, but we've already had 20%. Of those 20 companies, that not 20%, but 20 companies, 16 of them have beat the EPS expectation, 80% right now. That could not occur last quarter given the high bar expectations. And so those low bar expectations, you are seeing it already play out in both revenue beats and EPS beats, which it's early. We haven't even seen JP Morgan, but early nonetheless. Both of them are beating the 5 and the 10-year average. Both of them are beating the top end of blended growth. So it is set up to have a good earnings season. The market is set up to have a good earnings season, but and the market seasonality typically does have a good third quarter earnings season. That's why we typically do see good trending environments in late October and November. That's the entire reason we see that, quite frankly. You can talk about front running going into the holiday Christmas season if you want. To me, it's third quarter earnings season, which typically creates the trend going into the Santa Claus seasonality. So I think it's going to be a fascinating conversation. Come join us at Tackle Trading every single day as we break it down day in, day out.
Yeah, listen, very much looking forward to continuing these conversations. We got a fantastic community, Matt. There's ways to be a part of it. First of all, you can just go to our YouTube channel where you're watching this podcast, or Tackle Trading YouTube if you're listening to this. Listen to Matt and I every day on Tackle Today. We break down the stories, the charts, the analysis. Really enjoy it. Just a few minutes. You can come join us in the Traders Lounge. You can read that newsletter, be part of our pro community, tackletrading.com, and sign up for that 15-day free trial. I love our community. Matt loves our community. We give it our all. Just outstanding people, outstanding coaches, outstanding individuals, and we'll do our best here on the podcast.
Yeah, let me just very quickly. Mark told you 14 different ways to join Tackle Trading. It's really easy, guys. There's a link in the description. Hit that and come be a part of this great community.
Yeah, listen, everyone, have a fantastic week. Matt, enjoy the podcast. Thanks for joining me today.
Later, team.